So we're now going to have a look at the banking sector and more generally the investment climate, the investment landscape in the region. And we're going to start off with just a 10-minute session. We're delighted to have the governor of the Central Bank of Cyprus, Constantinos Herodotou, who's going to come here and give some opening remarks, and then if we have time I may ask a question or two. So welcome, Governor. Please join me on the stage.
Thank you.
Nice to see you again.
Nice to see you.
You can speak from here if you like, or you can sit. Yeah.
I'll do it from there.
Yeah. More informal.
Yes.
Good.
So, hello everybody. Let me make a few initial comments and then happy to answer any questions. Let me say a few words about the recent financial turmoil that originated in the US from specific regional banks in the US and how it spilled over in Europe, and what are the differences and what are the main lessons from that. Firstly, the key word in terms of what happened in the US is that it involved regional banks. But what surprised regulators, at least in Europe, and this is also at the European Central Bank level, is that up until that crisis, regional US banks were not considered systemic. Systemic US banks, it's a different category, different types of banks. And what it revealed, it was that contagion, global contagion, can happen even with regional banks. So there were specific circumstances as regards the balance sheets of those banks, but market sentiment and market volatility was such that contagion spilled over to Europe. And then we had the consequences that involved Credit Suisse. So first one, regional banks can cause global contagion. The second element that was revealing, and I'm going to talk a bit about the derivatives market, is the significant role of the credit default swaps in signaling to the markets that there might be an issue with a specific institution. Credit default swap prices, when they increase substantially, they indicate there might be a risk of default, but this is from a market's perspective. And people see that and they react to that, and hence its signaling effect. However, the reality is that the credit default swap market is not very liquid. It doesn't take a big volume of CDS transactions to actually cause a spike in the price, but the signaling effect is there anyway because people will just see the spike in the price. And then that creates the after effects that we witnessed, including bank runs, because in the digital age we are at, and here I'm entering in the last lesson, is that bank runs happen much quicker, much faster, and they're more difficult to control because even social media plays a role in spreading the word, spreading the panic, and then you see cash outflows from the affected institutions happening much quicker and much faster, which results in less time to deal with things. So these are the main characteristics and lessons, if you wish, from the recent events. Having said that, there are fundamental differences. If we look at the European regulation and banks, balance sheets are much more diversified for European banks because we have a single rule book that originates from the European Banking Authority. And we stress test the main banks of Europe, but that is a significant number. It's a much bigger universe of banks that are being stress tested in a consistent, similar way. And therefore, we consider the European banking system to be much more robust and resilient. I'm happy to expand further in any area, but I was told 3 minutes, I'll leave it at that.
Perfect. Thank you. Well, thank you for addressing that issue head on. So I guess, we've heard this line before that European banks are more robust, more resilient, much certainly compared with the previous crisis and in comparison with the US as well. But what would you say are the main strains and challenges resulting from this shift in monetary policy, this monetary tightening phase that we're in, higher interest rates, still pretty persistent inflation, in the context of very high levels of debt in Europe, actually as a result of the pandemic and what happened then, government support that was put forward. What are the strains as you see them? And I mean, you can talk about Cyprus maybe in particular and how Cyprus is positioned compared with the previous crisis.
Let me start at the European level and then I'll drill down to Cyprus. So firstly, monetary policy tightening is the only tool to fight inflation. There is no other tool available to combat inflation, and inflation it's much worse for businesses, households, because if uncontrolled, it keeps compounding. You get shifting inflation expectations, and then the impact on investment and disposable income is much bigger. Whereas the interest rate rise its objective is to bring inflation down, and when it comes down, interest rates will go back into neutral territory. So the increase in interest rates is not a permanent increase in the tightening territory. By this, though, we should not expect it to go back to those negative interest rates. The low for long is gone. Then, in terms of the banking sector itself, we are looking at it at European level as well as at the Cyprus level from a financial stability perspective. For the time being, there are no such concerns because of the buffers and the resilience in the banking sector. So liquidity is very high when we look at European banks, as well as capital ratios. Indeed, and you're absolutely right, if we look at the private debt, household debt levels, they are high. They're even very high in Cyprus. But I go back to my initial point, inflation is more detrimental than interest rates. If we look at Europe, then you have to look at the differences between member states, because certain member states have variable interest rates in their loans, others have fixed, and therefore the impact on households and businesses is different. But it's a unique market. It's one complete market, so it's one set of interest rates. But having said that, and let me now talk specifically about Cyprus, we have one of the highest liquidity ratios within the European Union in our banking sector. So the average in the EU is around 164%. In Cyprus is 318%. It's almost double the EU average. And it goes to show how resilient now the banking sector is. Our capital ratios are higher than the EU average. And then if we look at it from an economy perspective, comparing against Cyprus with the Eurozone average, we have a much higher projected economic growth for this year versus the Eurozone average. We are at 2.6% for 2023 versus 0.9% for the Eurozone. But our actual inflation rate is below the Eurozone average. So it's a very, very good dynamic that we have currently at the country level.
So you're not particularly concerned given the cost of living crisis, which again will persist as long as inflation, so inflation will be decelerating quite rapidly, especially in the second half of the year, but in terms of levels, compared with the previous period, it will still remain quite high. And then we have the higher interest rates. So we do have a cost of living crisis for more, let's say, vulnerable members of society. You're not worried at all about increase in NPLs in the banking system in the coming period?
The cost of living is an after effect of inflation. Interest rates are the tool against inflation. In terms of the vulnerable, it's always been the policy of the European Central Bank, which we adhere to also, which is there should be fiscal support but targeted to the vulnerable. If not targeted, then it's inflationary. Let me not get into the technical details there, but yes, the vulnerable should get assistance. And this is implemented in Cyprus as well as in other European countries. They are withdrawing these horizontal support measures, horizontal meaning across the economy, across all sectors of society, and focusing it more on the vulnerable. There is a risk of an increase in non-performing loans, so we're not saying everything is fine, but that risk is low, and for sure our banking sector is resilient enough and has sufficient buffers to deal with it should it arise.
Mm-hmm. Okay, just final question, just to broaden it out a bit more, to kind of take a broader macro view. You already talked about Cyprus' real GDP growth, growing at faster rates than the European average. So what are the strong points, you would say, of the Cypriot economy at the moment? Why should it be a destination for investors from the US or elsewhere?
It's a small open economy, and the key word that comes out of that is flexibility. So we were concerned so far with the impact on the economy from COVID, but actually the economy showed its resilience from that. We were concerned whether there would be an economic impact because of Russia's invasion of Ukraine, but again, nothing material is happening because the tourism, which was the main area that was a concern, has been more than made up of from other European countries. I would add that there is actually a big increase of investment coming from Israel, that we see that at various levels, and I'm happy to say it's not just investment that takes advantage of the corporate tax rate. It's actual enterprises are moving into Cyprus, so they bring their personnel staff, so it's a real input into the economy with all the positive externalities. If anything, infrastructure needs to catch up a bit with this in terms of more private schools and hospitals to deal with this actual increase in companies with their personnel moving over. And these are the main elements that are also attractive for US companies that are already, as we have heard, investing in Greece. But Cyprus's proximity as well as good relationships with Greece are beneficial for everybody in terms of the region.
Mm-hmm. Well, thank you. I'm afraid that's all we've got time for, but thank you for being so open and direct in this conversation. Thank you very much indeed. Photograph.